Why traders often misread the first market of Middle East geopolitical shock. When tensions rise in the Middle East, most readers run straight into gold or the dollar, but the market often starts its reaction somewhere else. If you misidentify that first move, you will usually misunderstand the rest of the chain. By the end of this piece, we'll break down the market reaction in sequence: oil, then dollar, and inflation, then gold, and finally risk assets and crypto. The first mistake is assuming that geopolitical shock shows up first in currencies or gold. In conflicts like those in the Gulf region, especially when the Persian Gulf and the Strait of Hormuz are involved, the first impact usually lands on energy markets. The market's first question is not who will buy the dollar, but is oil and gas supply still secure? Every time doubts about a ceasefire or concerns over the Strait of Hormuz increase, crude oil prices tend to spike. At times, they have even risen above $100 because the risk of supply disruption quickly becomes more important than the political headline itself. In this context, oil is treated as far more than a simple asset. It becomes a channel through which pressure spreads into the broader financial system. When oil prices jump, the market quickly starts repricing inflation, growth, and interest rates. That means if a regional conflict drags on, the story is no longer just about geopolitical fear. It turns into a cost shock for the global economy. The IMF and the World Bank have already pointed out that local wars, higher energy prices, and even food-related costs feed stress into import-dependent and highly leveraged economies. Here, the third layer begins: the dollar. But not the same dollar everyone talks about. The dollar can strengthen for two different reasons: because investors seek liquidity during risk-off episodes, or because rising oil prices and higher inflation makes it harder for the Federal Reserve to keep lowering rates. This difference matters because the market reacts differently depending on which driver is in charge. If the dollar gains strength mainly through fear, that move can be sharp, but it may not last. If the market concludes that an energy shock will push the Fed to delay cuts or even tighten its stance, then dollar strength starts to look more structural. The latest Fed minutes reflect that some members have become more sensitive to inflation risks linked to war and energy. After that, many traders jump to the same conclusion: gold must only go up. That belief itself is another common mistake. Gold only tends to benefit from geopolitical tension when the market simultaneously expects a real interest rates to soften or systemic mistrust to deepen. If oil prices rise while the dollar and bond yields are also climbing, gold can get stuck in a tug-of-war. Safe haven on demand on one side and the pressure of a strong dollar on the other. That is why in this environment, simply saying war has started so buy gold is not enough as analysis. You also need to watch what that bond and dollar markets are signaling. Crypto and other risk-on assets usually show their reaction last in the chain, not first. If the tension looks short-lived and containable, some risky assets may even catch a breath. But if the market senses that the energy shock will be persistent and central banks will turn more cautious or even aggressive again, then risk appetite suffers. You can see this logic now in European and US equities. Whenever ceasefire doubts rise and oil climbs, stocks come under pressure again and the market returns to worrying about growth and inflation. So the chain reaction usually looks like this: first oil, because the market is judging the security of supply, then the dollar and interest rates, because the market is pricing the inflationary and monetary impact of the shock, then gold, which is squeezed between geopolitical fear and the strength of the dollar, and finally, risky assets and crypto, when the market finally decides whether it is facing a short-lived news-driven scare or a genuine long-lasting economic shock. Traders who mix up this order often enter too early, exit too late, or fail to recognize that the narrative has shifted. The right question is not just which markets does Middle East tension affect, it is which market reacts first and how does the rest of the chain follow. If you read that sequence correctly, many of the fake moves and emotional spikes suddenly become much clearer. If regional tensions rise again, do you think the first reaction will still start in oil, or do you expect the dollar to react more directly than the rest? And what lesson have you personally taken from the recent Middle East shocks? Share your view and let's see how others are mapping the same risks.